Max, good to have you here. Introduce yourself in a couple seconds and let's go on with the topics you want to cover.
My name is Max, and I'm really interested in what we're going to cover today. And yeah, that's about it. I'm excited.
No, hold on. Who are you? What do you do for a living?
I'm running a moving company, and I'm also a DJ, a producer, and
And you're
that's what I
following
do.
your dream, right?
And following my dream, yeah, in LA
I mean, you
now.
moved to Los Angeles basically to follow your dreams. So that was very aggressive move, very, I guess, how you say, decisive move. So I'm proud of you that you're actually pursuing what you want, right?
Thank you very much. Yeah, I'm excited.
Okay, now that we had introduction out of the way, let's kick this off. So tell me what you want to talk about and any specific questions or topics.
Um, I just wanted to um, actually find out about how's everything works um, with the market, right? Is that what we're gonna discuss?
Okay,
Yeah.
now go ahead.
I have no idea what is it, and honestly, I was always kind of wanted to get into it and to see how it works. And for myself, I think it will be a really interesting experience to learn something new, educational, and actually get into it as much as I can do. Yeah.
Okay, so let's narrow down the topic to a bit more something specific. So you said how everything works. So let's start with topic by topic, I guess, right? Because otherwise it's pretty big question. So kick off with the first, I guess, pointed question. Where you want to start?
Um, just with an explanation of what it is, how it works, and what's in it. And
Okay,
yeah,
so we have, when we say markets, we have basically anything as a market, right? Basically, real estate is a market, stocks is a market, bonds is a market, cars can be a market, right? So every time we have buyers and sellers, we can call it a market. I think what you asking more is about financial markets, right? Is stocks, bonds, commodities, futures, options, that type of stuff, right? And
correct.
perhaps also real estate. Basically, we why we're interested in these topics is because they allow us to do investments or trading and potentially make profits. So whenever we have buyers and sellers, we have a market, and whenever we have fluctuation of price, then we have opportunity to make money. Make sense, right?
Yeah, yeah.
Okay, so okay, let's talk about stocks, I guess. So for stocks, you have different categories, different price points for stocks. Some of them are very expensive, some of them are very cheap. You've heard about penny stocks, right? They're very cheap, like $1 per 100 shares or a share.
Yeah.
And you have very expensive, like Berkshire Hathaways and Amazon and Facebook and such. So that's one. And right away, before we switch topic, so how price impacts market participants? Let's say, and also the similar topic, why there are so-called share splits. So why the price is impacting some participants? Because let's say you and me are poor, right? And we only have $100. That by itself means we cannot buy shares of Amazon because it costs like $2,000 per share. So, and what I said, stock splits is it's an event where a company decides to change the price of the stock by manipulating the amount of shares outstanding. Outstanding means how many out there issued. Usually that's very determined number. Let's say 1 million shares, 1 billion shares, and so forth. They have to register with SEC, how many shares they want to issue, and so forth. Every time they want to issue new shares, they have to make an application with SEC, Security and Exchange Commission. So it's not like wild west where you can do whatever you want. Whenever you first time issue shares, it's called IPO. You specifically say, I wanna sell that many shares, and that's a starting point. Whenever you wanna sell more shares to whatever you already been issued, you need to file application, get approval, and so forth. So whenever there is a stock split, is when they decide to, let's say, yes, they had 1 million shares and they trade $1,000 each. So to make it cheaper for more people to be able to buy it, then they do something like, we're gonna have not 1 million shares right now, but 2 millions of shares. So the price starting tomorrow morning gonna be not 1,000, but $500. So that's one interesting aspect. Now, some stocks are liquid, some stocks are illiquid, and that have to do with how they trade. Liquid means that on any given day there is enough buyers and sellers, and there is not a big problem of buy and sell. There is always somebody out there. Illiquid means there might be a challenge to sell whenever you want to liquidate your position. So that's something to keep in mind. Usually that's not a problem, especially on American markets. But if you have something like very, how you say, exotic on your hands, let's say it's I don't know, early IPO of some company that nobody ever heard before, then it might be not a lot of buyers if you want to sell. Okay. So in stocks, we also have events that drive market participants' decision. They are news. So for example, you are a biotech company and you are working on some sort of cancer drug. So for them, it's very deterministic how they're gonna behave, because they have FDA approvals, trials, and so forth. And every time there is a next stage of next milestone, usually price reacts to that. Like if it's positive, then perhaps it's gonna go up. If it's negative, it's gonna go down. Perhaps it's not always the case. So that's one example of news. The second example for news could be upgrades and downgrades from rating company. So for example, you probably heard about Moody's, Standard & Poor's, and Jefferies and other rating companies. What they do, they have teams of analysts and they cover specific stocks usually. So once in a while, they would issue an update on their what they think gonna happen to stock. They would say, we upgraded to overperform or underperform or so forth, right? They change the rating. And that also is a news big enough that's gonna impact immediate price behavior. So in the long run, it might not matter. Like say, if you think about quarters or years, might not matter. But within today, it's gonna spike or drop based on this news. And then we have more sector-based news. Let's say you have a share of some sort of mining company. They mine steel, ore, or gold, or whatever. And you have some sort of new president in office, and they're gonna try to push like green energy or something like that. Then that might mean that mining company is gonna have a problem with their revenue and so forth. And those investors that are heavily interested in the future revenue of the company, and that's the reason they buy in shares, they might start to unload their position because they would see that the bottom line of the company, the profit's going to be shrinking. Yeah, one thing very important to know about markets is that do not try to rationalize from your personal perspective what's going to happen with the price given the news. I would say it's 50-50 what's going to happen. Let's say you as normal logical individual would perceive that this is a positive news. In reality, price might go down. And there are reasons behind that, but you don't even care about specific reasons. In fact, you shouldn't care. You just have reality on your screen, price goes down, news supposedly positive, price goes down. That's all you need to know. You don't need to rationalize it, you don't need to understand it. the more you go that rabbit hole, the more problems you're gonna have. And I haven't seen anybody that would purely buy on news and would do well over a long period of time. So usually successful traders or investors, they are more sophisticated than that. They watch price action, they watch what price actually suggesting. Is it going lower? Is it going higher? And they start to build a position, build the, I guess, rationale of how they gonna manipulate their position given the price behavior.
Got it.
So does it make sense? Because this is very crucial. A lot of people get in trouble by trying to dictate to market what market should do, while market doesn't give a shit about what you think it should do. It just does what it does.
Yeah.
So think about like ocean and waves. Like doesn't matter what you think or believe into, waves just gonna keep on going one way or another, and they're gonna change, big, small, and so forth. So that's very key to understand. Not to mention, given the experience in this field trading, I probably have more than a decade at this point. I noticed that there is a evidence that might suggest that there are indeed companies and mass media that on purpose manipulate public opinion to move markets one way or another. So, for example, we talked about rating companies. You well can see that they might issue positive or negative rating just to satisfy specific intentions. Like, let's say they want major public to buy in the news because they issue positive upgrade. And that's exactly what perhaps some market participants wanted. There is always two sides of the trade, right? Buyers and sellers. So public is buying on the good news. There are big, I call it big wallets, right? They have a lot of money. They want to dump shares. So perhaps they have some sort of linkage between these two, and they work in a unison in one way or another. But obviously, it's a theory more so than I have very specific proof. But looking at markets over a long time, that happened many times where the price would tank on a upgrade, for example, or something like that. Okay. And yeah, there are very well-known public personas on TVs like Jim Cramer and others who are very vocal about specific price behavior or predictions. And a lot of people trade by listening to those shows. So that's what I started this conversation, right? Don't try to predict the price in a specific rationale.
Correct.
So there is no rationale behind markets per se. You usually can come up with rationale looking back in the history. So, for example, from this moment on, 5 years from now, we would look back on the price of gold and we would see it actually went down. And then we're like, oh, okay, I guess it makes sense. It went down because such and such country somewhere overseas were struggling with delivery of their new mines or whatever. So we can piece together potentially explanation. But in a moment of time, you have 50-50 shot on predicting the price for this moment of time. It's a bit, I would say it's a bit easier with more, I guess, predictable markets like real estate. I would say a bit more predictable because real estate is pretty straightforward. You have mortgage companies, you have insurance companies, you have buyers, you have sellers, you have developers, but more or less they all circle around this crucial element, which is federal's fund rate. What is the price of the money, basically? And that impacts mortgage rates, and mortgage rates impacts purchasing power. And if purchasing power deteriorates, that means nobody can buy houses. Houses going to go down. Like there is no question about it. So real estate is a bit more predictable. Yeah, as we right now in real estate world, let's talk about that real fast. So in real estate, you have a couple aspects. One is tax advantages of owning real estate. You have, we talked about mortgages. Mortgages are typically following the 10 and 30 year bonds. So the way they trade, that's how mortgage gonna behave. And those bonds are typically impacted by federal funds rate. So whenever central bank rise in the loan rates, you have this chain reaction. So real estate, you can have tenants, you can rent it out, and you can have income. And again, it's tax beneficial to you.
Mhm.
And we tend to believe that real estate always goes up, right, in price. And we can make a case it's perhaps the case in, I don't know, last 100 years. That said, the quality of housing, I mean, you somewhat close to that, right? You did moving and you see all the housing every day. The
Correct.
housing
Yeah.
itself deteriorates over time, right? The actual
Yeah.
quality of housing is going down, yet the price goes up. So you need to have that rationale in your head, thinking that sure, mathematically it's going down, but I still need to change roof in 5 years and it's going to cost money, type of thing, right? And I need
Mhm.
to do maintenance and so forth. Because I think the mainstream public, they just have this staple in their head that real estate is just safe investment, always goes up and never goes down, and that's it. They golden as soon as they have their own house. So for one, you have to maintain it. For two, it's probably going to be not always the case, especially right now. We see the effects of federal funds rate going up. Housing market completely stopped. And I know a lot of people who were either trying to buy or sell, and none of that is happening, especially in specific markets. And the sales went down, and builders froze their projects to a degree. And we probably going to see more hikes in the federal funds rate, which means it's going to make it worse and worse, perhaps. And we may or may not see prices going down. The aspect here is that a lot of people, they bought houses with the cheap mortgage, like 2.6%, whatever. So for
Mhm.
them right now, unless they really have to, it's not advantageous to sell, because where are they going to live? They won't be able to buy a new one because the rate is high.
Yeah.
So that's why we kind of see stand still right now. Not much going on with buying and not a lot going on with prices going down, because people not really want to sell because they really have a dilemma what to live afterwards. Okay, let's go back to stocks. So we have thing called charts, right? Charts are just visual representation of price action over history. We might see 5 minutes as a period of time. You might say months, year, or decade, and you will see it as respectively on the price, on the chart price. Why people look at charts? Well, I guess it's just easier to comprehend history by just looking at the line or candles, and you can immediately see how the price behaved over time, and you can make some sort of conclusion. Oh, it was going down, it was going up, right away for the long period of time. Or I mean, as long as you want or as short as you want. Where if I'll tell you price momentarily, it's just one snapshot, right? You don't have a history, so you can't really derive any kind of conclusions. Okay, so there is so let's talk about what impacts the price, at least from experience of a trader, right?
Mhm.
Because we spoke about news and impact of news, saying basically don't look at news as positive or negative, just look at the price. What impacts the price is buyers and sellers, same as the house. The more buyers want to buy, they start to compete, they start to raise their stakes, meaning raise their bids, and therefore they raising the bar higher and higher. And same goes with the sellers. The more sellers eager to sell, the more they're going to compete by lowering the price. So we can have a lot of analogies for this anywhere, right? You want to buy a car, you want to buy it from Craigslist or something, and you have 3 people already standing and looking at the car. You want to, if you really want a car, you're going to outbid them, right? You're going to say, hey, don't listen to them. Here's 10 grand cash. Here you go. Give it to me, right? So the same idea happens with stock market or any kind of market. If there is a pressure from buyers or sellers, price going to go in that direction. So you, as a trader, investor, your job is to be able to sense that there is a pressure one way or another. And again, the time frame matters, because you might be able to sense it right now in the moment, but would it matter in 5 years? Probably not. Would it matter in 1 month? Maybe. So therefore, you need to sense this pressure or lack of it on a very specific time frame. You as a trader, you also, coming from this previous idea, need to know what's your time horizon. At which interval of time do you want to make or try not to lose money? So let's say you have very practical case, you have 10 grand and you're thinking, well, I don't want to spend it. I want to try to grow it. I don't need them until my kids go to school. And that's like 10 years from now. Let's see if I can grow 10 grand. Or maybe bad example, because kids still would like to use 10 grand. If you're going to lose them, they're not going to have them. But let's imagine that you are more opportunistic and positive outlook on life. So your time horizon is 10 years, right? So in 10 years, you wanted to be above 10 grand. And then that above can differ. For you, 20% might be good. For somebody else, they want to double at least. And for somebody, even that would be not a lot. So the appetite changes from person to person, and from fund manager to fund manager, and their time frame also is different. And this is, by the way, some of the aspects how to think about price action. Why it may go up on the negative news and go down on the positive news, because time horizons are different for different people, and their perspective and plans are different. So if you are right now, using the previous example, at the end of that 10-year plan for your kids going to school, and you need to cash out because you're already making money, you might want to use good news as a way to get out on a high, right? It's kind of like a sportsman. They go, a soccer player or any kind of players, they want to end their career on a high, right? They don't want to end their career where nobody even remembers them.
That's
so
right.
Similar idea here. A lot of times people sell on the good news. So hence now you understand why following the news makes no sense, or one of the reasons. So we talked about time horizons. We talked about different players. So what are the different players? We can differentiate players by their time frames, actually. Some are day traders. You heard that a lot of times, right? On the TV and books and such.
Yeah.
Some are scalpers. So what scalpers do, they trade in seconds. So basically they're like robots. They just hit on keyboard nonstop. I've seen in real life how it happens. Like the way you play like a Counter-Strike or whatever game where you have to constantly adjust navigation, that's how fast they trade. Each button is sell or add to position. The other button is buy, and so forth, and cancel orders. So they're like those people, secretary on the keyboard, right? So that's scalpers. Then there are day traders, and then there are swing traders. Swing traders, usually their time horizon is about a couple days to a couple weeks. So they want to take these waves of momentum. And then there are long-term traders. They probably can be said they are, I don't know, couple months to couple years. So let's say they bet in that dollar gonna have a problem, people gonna go into gold, and therefore with sometime within the next 5 years, gold gonna be going higher. So they don't want to deal with overthinking it. They just say, well, if it's going to go higher, ultimately, I'm just going to buy and hold for 5 years. So, and again, they can make that execution during specific news. So they might be buying on the negative news because it's got cheaper momentarily and they want to buy it even lower, right? So
Mhm.
they got their price and now they're going to hold for 5 years. And then they're going to sell on the good news. Okay. So we talked about time frames. We talked about price action. Then, so let's talk about stock exchanges, right? What role do they play? So they used to actually play a role where those people that screaming and shouting actually made some difference. These days, most of it is controlled by algorithms and computers. So what the people you see are brokers and market makers. Market maker is the person who is responsible to make sure that there is always buyer and seller for a specific asset. Let's say, let's use an example. If I'm a market maker for stock called Apple, it's my job as a worker of the exchange that there is always a buyer or a seller. So if I see there is not a lot of buyers, I'm going to become a buyer myself with the capital that is allocated for me to act as a market maker. And therefore, if there are no sellers, I can sell my own shares to make sure buyers can get the orders.
Yeah.
Well, at least that was the story behind their activity back in the day. And these days, most of it's automated market makers. And I'm not even sure what those people do anymore on the floor. And as you notice, they no longer shout; they just kind of stare at the screen with melancholic look. Um, okay, so there are a variety of exchanges. Exchanges usually specialize on very specific assets. Either are stocks, or they are bonds, or they are futures, and so forth. So in the United States, which is the biggest market thus far, is we have NYSE, New York Stock Exchange. We have NASDAQ, which I think is still located somewhere in New York. And we have Amex. I don't remember. I think it's also in New York. And then we used to have small ones, and we still actually have small ones. I think there is Philadelphia, there is Baltimore, I think, and there's probably something in Chicago and so forth. So those are operating stocks. Then there are, and mostly Nasdaq is technology stocks. So when you see the index of Nasdaq is going lower, that means technology stocks are going lower as a group. And then there are futures. So the center of futures trading is Chicago, CME, Chicago Mercantile Exchange. So if you ever hear that lettering, that's where it is, Chicago Mercantile Exchange. Okay, so what is then futures? So futures is the contract for a future delivery of some sort of asset. So we can have futures for Apple shares. We can have futures for gold. We can have futures for, I don't know, natural gas. So the easy to remember is it's delivering the future for something. There is some sort of underlying asset that we deliver in the future. And today, whenever we have a transaction of buy or sell, we basically sign a contract that you're going to deliver me something in the future. And they usually have like a couple months window, like a quarter, where you hold this contract. You can still trade it, but if you decide to do so, you can take delivery of that contract. So a lot of times nobody takes delivery because, okay, you are Max in San Diego, LA, right? Do you want to take delivery of a ton of gold in your house? So
No.
realistically speaking, nobody takes delivery. So futures market are mostly there for trading only. And also it predominantly used to hedge positions. So let's say you have a position in gold, just straight up gold, like you own physical gold or ETFs. We can talk about ETFs in a bit, what it is. So you hold gold physically, so therefore you have a, what's called long position. You interested for the price to go up.
Mm-hmm.
Long and short, two types of trading. Long means you bought and you hoping it's going to go up. Short means you sold it short and you hoping it's going to go down, so you buy it back cheaper. We'll come back to it if needed. So you hold gold. Now you watching the news and you start to get a feeling that it might be not all rosy in the future. Maybe the price gonna momentarily for like a quarter or two go lower, or even go lower for your time frame. Maybe like you was trying to hold for 5 years, but now you start to wonder, maybe in 5 years actually it's not going to go up. So what you can do, you can hold your physical gold and buy a futures contract for like a cheaper price of delivery within that interval. So you buy it cheaper again or something like that. Or you can I guess what else you can do, you can sell the delivery of that gold at lower price. Actually, I mean, you're gonna be in loss, right? Because you bought it probably higher. Anyways, you got the idea, right? It's a way for you to not lose your actual position, but take temporary position, or usually it's a contrary position. So let's say you hold your physical gold, but you also don't want to get hit by the markets. You buy, it's insurance basic. You buy it as a protection for downside. So how it works in practice, a lot of times oil company would use futures market to protect their position. Let's say they're not sure if it's going to be political stability in the world. They don't know if they're going to get oil from, I don't know, Iraq or Venezuela or something like that. So they might expect that it might be shortage of oil. So if that's going to be a shortage of oil and they're going to underperform if they are sellers of oil, so they want to protect themselves and they would buy futures contract today, anticipating that in a month or two the price actually will be higher because there will be shortage. So they're going to make money on a future contract to compensate what they're going to be selling short on actual inventory. Does this still make sense?
Yeah.
Okay, so that's
maybe,
futures.
Maybe it's somewhere yes, somewhere not. So it's
okay. Whenever you want me to slow down, whenever you want me to slow down, then raise your hand and we'll dive deeper or give more examples. The typical average Joe doesn't trade futures. It's usually for bigger traders. And
so the futures, they're more like a long-term investments. So they, like, let's say they buy a share and they see how it goes up, goes down, and when they feel like it's they kind of like predict the future of it first, and then they see how it grows, and then like at the moment when it's maybe it reaches the peak that they're pretty satisfied with, they kind of sell them, right? That's what it is.
So with futures, that can be true. So let's say you have future with delivery in 3 months. That means from now until 3 months from now, you have a chance to sell your futures. And it's up to you to determine when you're going to do it. But the logic of buying that future in the first place was a lot of times to hedge against the something opposite happening to your actual position in either physical asset or in shares and so forth. So you was buying it as an insurance, contrary to your actual position. But there are people who actually trade futures straight up. they don't really have anything to hedge. They just betting that oil or markets would go up or down, and they just buy or sell futures for specific future date for specific price. Okay, then we have options. So options, from the name itself, you can remember that you buying an option to execute a trade at some price, again, within time frame. So for example, if I'm spending $5 right now to buy from you an option to execute a purchase of shares at $155 for Apple within the next 3 months, that's basically what it means, as an example. So within these 3 months, you can make decision that I actually don't want to execute this option, and you're just going to let it die, basically. So there are writers or sellers of options, and there are those who buy those options. And you can buy them both ways, up and down. So if you think market is going lower, you can buy what is called put options, so that if market drops, then you can those options are growing in price if things are falling. And if you thinking that things are going to go up, you can buy a call option. They are growing when the price goes up for underlying asset. So if you think about it, why people like options so much? Because you can get exposure to a specific direction while you're only risking $5, for example. You don't have to spend all this money to actually buy shares or sell shares. You just buy an option. So you pay for the actual contract, which is typically much cheaper than asset itself. And you get exposure if you would actually have those shares already in your possession. But you don't. And in fact, if it doesn't go your way, you don't have to execute that transaction. You just like, okay, well, fuck it, I lost $5 type of thing, you know?
Yeah.
So your downside is very limited. Whatever you spent on purchasing that option, either put or call, that's your bottom line. So I like it from perspective if you're not fully sure. I mean, I guess we're never fully sure, but if you actually not sure, then option gives you good exposure while not risking, while your risk is very determined, and it's usually pretty small, comparatively speaking. Make sense?
Yeah.
Okay. What else? So now let's move away from stocks. So we have commodities. Commodities and futures are very similar terms, because usually commodities are traded by buying and selling futures. Commodities are metals, energy, like oil, natural gas, and then we have some sort of agricultural, like rice, orange juice, and things like that. Those are commodities. Why they call them commodities? Because we use them in day-to-day life of humanity. We need them all the time, always.
Yeah.
So we call them commodities. And usually commodities are a bit more straightforward compared to stocks. Commodities usually are strictly by supply and demand of that commodity in the world. So if there is some sort of disease that is attacking plants, there will be low harvest. Low harvest means less of the supply. That means price of that commodity gonna go up. So yeah, commodity is a bit cleaner as far as market operation. Yeah, it's hard to predict it because you don't know weather, you don't know wars and things like that. But the price discovery is very straightforward. You know how it becomes true. And also markets of commodities are huge usually, right? Like think about all the oil in the world, right? Or all the gold in the world. So manipulating them, it's pretty hard, unlike very specific stocks. So if your stock is something small, I don't know, mom and pop shop, branch, right, or small chain, you probably can manipulate the whole stock with, I don't know, $100 million. Or for manipulating oil market, you need probably like $1 trillion. So therefore, it's a different type of mechanics.
Mhm.
Okay, so by the way, to be a manipulator on any market, you need to be large enough to be able to manipulate buyers and sellers, right? So you need to be able to compensate for buying power if there are sellers that you want to push higher or something like that, and vice versa. So you need to have decent amount of capital, which is large enough to be able to impact the price. Okay, what else? Okay, earnings, right? Companies set earnings a lot of times, not always. Earnings usually happen quarterly. It's when companies announce to their shareholders in the world who is listening to those calls how the company has been doing through some period of time, last quarter, for example, last year, and how they perceive their future results for the next quarter, next year. So during those calls, they talk about that, and that's how a lot of people determine what they want to do with the stock. They want to buy more, they want to sell, and so forth.
Yeah.
And again, what we talked earlier is that some people would decide differently than the others. Therefore, you shouldn't anticipate the price behavior based on the earnings calls. Okay, so when companies do not have earnings calls, is because it's public companies for one, and for two, they need to be, usually those that are listed on exchanges have to adhere to different regulations, variety of regulations. One of them is to have earnings and their, how you say, corporate operations to be reviewed so that market have unified knowledge about how companies doing. Everybody knows exactly the same information. It's kind of the, how you say, Transparency Act or something like that, where SEC wanted to provide all market participants the same identical information so that you can make your own decision. And to achieve that, they push companies to release earnings. So which companies don't have to do this? Those that are not listed on those exchanges, for example, right? So if you're not listed, well, nobody's pushing you to release any information. It's up to you. So then the next question, why do they go to be listed, right? What's the urgency to get to NYC and NASDAQ and Amex? Why they want to be listed as a company? Because company have a power to issue shares. Basically, it's practically free power. The only cost is to file registration with SEC and get approval, and I don't know, maybe hire some attorneys, and here you go. What do they get in exchange for those shares? They get actual capital from the market. They basically can dispose those shares one way or another at the open market and get cash, real money for shares that were really cheap or practically free. So in a way, being publicly traded company is a Federal Reserve for the company, right? The printing press for the company.
Yeah.
And for type of stocks that are like penny stocks, this is actually the reality. The only reason they exist in the market is to get money from the market. Wow. They typically struggle. They have no real plan that works. They have no real product that works. They're just there to make money from markets. And to help with the marketing of those shares, they create some sort of news reports. They might, I guess, again, from my experience, they might have a relationship with a rating agency. That rating agency would issue some good rating for those companies and so forth. Wow. But they only exist there to prop up their shares and sell them at the open market, and they do it over and over and over again. But at some point, people start to learn that seems like the only thing you guys do is selling shares, then why would I buy them? So you kind of need to have a marketable balance, marketable shares. Okay, does that make sense?
Mm-hmm.
Okay, so whenever you hear something like, hey, I bought a share, now I'm a shareholder, my vote counts, don't really think that's true, right?
Mm-hmm.
For one, who cares about your vote? Do you really care that you can vote? Like, I don't care. And two, yeah, it counts until they print more share and sell them. That's called dilution of existing shareholders. So let's say today we have 1 million shares at the market, and then they decided to issue 500 more. So what happens to existing shares? The capitalization of the company is the same. Now we have more shares. So old shareholders versus new shareholders competing for the same amount of money of capitalization. So in reality, what they used to buy for like $1 now costs 75 cents. So overnight, a company with issuing new shares can lower your value of your holdings overnight without asking you any questions, whether you happy with it or not.
Wow.
So that's something to keep in mind. But that usually happens for cheaper, less known companies. Usually the marketing strategy for well-known companies is different. They actually want to maintain good marketing for those shares. They want to maintain good name and image. So they don't play these games usually.
Mm.
Okay, let's talk about dividends, right? So what is a dividend? It's the moment of time when a company decides to distribute part of their profits to existing shareholders. So if you buy, let's say, a share of Disney, and at some point Disney decides, this quarter we made enough money, now we have a couple $1 billion. Let's use 1 billion to dispose to current shareholders to reward them for holding our shares. Again, it's marketing, right? So now I have incentive to hold shares of Disney with the hope that they might give me a dividend if they feel like it in the future. So, but the crucial here to understand that it's a decision by a company. There is no force on them to do it consistently every time. They can cancel dividends, they can raise dividends, they can lower dividends. So it's not consistent. You can just rely on a history, track record of the company, and just good hope that they're actually going to do it, given their profits and strategic decision from the company. So that's dividends. And yeah, not all companies are paying those. Only well-established companies are typically paying those. And also, I repeat, each quarter it's a decision for them how much to pay and whether to pay at all. They might use that money to spend on research and development instead.
Mm-hmm.
So, okay, any questions so far?
So far, no. So far, so good. Yeah.
Man, it's been like half an hour, no questions. It's either I'm doing good job or you're doing bad job.
Yeah, you're doing a great job. Yeah, it's very
okay. What else? So we talk stocks, we talk those. Okay, we can talk about market cycles. So usually market cycles, what it is overarching reaction by markets on some sort of climate. Usually have to do with federal funds rate or general availability of money. If money is cheap, usually it's a bull market. If money becomes tight, like think about the economy, right? If you're struggling to pay rent, then it's not good for anybody. You're gonna get evicted. Your landlord gonna get a shortage of capital. They're gonna have a headache to find new tenant and so forth. So cascading reaction. Same happens to markets. When there is a shortage of capital, company starts to struggle, revenues goes down, and markets typically go down.
Mhm.
So yeah, we have bear markets when things go up, and bear goes down, and bull when everything goes up. Okay. What else? Well, we have, I guess, TV channels, right? We have Bloomberg, we have MSNBC and things like that. Those
Mhm.
channels a lot of times have dedicated, either whole channel is dedicated for covering markets, or they have specific sections or specific people who cover those markets. And again, they can be part of the manipulation approach for the mainstream, for the public.
Mhm.
Okay. So yeah, now let's go more practical. How to actually participate in markets, and whether should you or should you not, and so forth. So I
Perfect.
think first question is coming from this direction. We need to acknowledge that the only reason to participate is to make money, right? The only time we make money if we either can predict the price or we're lucky, right? So, okay, if you like luck, sure, it's one of the ways to gamble. If you think you can predict the price one way or another, then that's the other way to hope for profits. So how can we predict the price? As we said, that price is driven by buyers and sellers over time frame. So if you think you have sufficient amount of understanding one way or another that it would be buying pressure over a period of time, then price is going to go up. Then if you buy now and sell later, you're probably going to be in profit. How do you get that conviction? Conviction is a fancy word for saying, I think I know. That's what conviction really is. So how to get conviction about price movement? You probably should become really an expert on specific niche. So for example, for you, it might be transportation companies.
Yeah.
And for example, what impacts the revenue of those companies, or what would make somebody want to actually buy those shares? Again, there is something we haven't talked about yet. There is real economy and there is stock market. They are not the same thing. Like, I can make decision to buy and sell share for no fucking reason, right? Not even turn on TV. I can buy and sell share any given moment if I have capital. But there is also real economy that might stimulate a decision to buy or sell shares.
Mhm.
It's kind of secondary effect on real action. Okay, so let's imagine for majority of people, they actually buy because of, or buy or sell because of their fundamental company operations. Therefore, if you subscribe to this thinking, you need to be able to comprehend and predict company likelihood of company doing well or worse in the future, right? So how you get that? Well, you need to study either those sectors, like transportation as a whole sector, or very specific company like Schneider, or I don't know, some other companies that are in transportation sector. Once you think you got it all, then you can bet on your thinking by buying or selling shares. That's basically what trading is. So let's say, again, practically, number one, you need to be building a conviction based on your understanding of situations. You need to get that understanding one way or another by reading, researching. A lot of those companies publish their balance sheets, and you can read all that all day, every day. Is it sufficient enough for you to make a decision? Maybe yes, maybe no. It's your decision. Now, let's imagine one way or another, you build the conviction. You have a feeling that you know what's up and it's going to go up. So now you need to answer a question. How long is my time frame? Is it 1 month, 1 quarter, 1 year, 5 years, 10 years, and so forth? Maybe it's for my grandkids, because I believe, for one, the stock is going to be still there and it's going to be much higher than today. So yeah, that's the second decision. What is my time frame, time horizon? And 3, when to execute. Do I wait for lower price to buy? Do I wait for negative news to buy? Do I wait for confirming news to buy? Do I wait for price actually to start going higher so I buy? All of those could be angles for you to think when to enter. And same goes with during your position. You can add to it or you can sell it. And same goes with your selling. Basically, selling is reverse. You either sell deterministically, you just, for some way, you made a decision, I'm just going to sell when it hits $100. Like, no logic behind it. You just, like, I don't know, you want to exit $100. It for some reason matters to you, then this is one way to get out of your position. Second way to get out is reverse of what we discussed when you enter position. If you develop conviction that company stop doing well and actually start doing worse, maybe it's time to get out. So you get out not price-based, you get out not the number-based, but you get out based on fundamentals. And the third way is strictly by watching the price action. As you see that you start feeling that the price is not doing well, it's no longer can make new highs, and you just don't feel like it anymore, then you can make decision, it's good time to get out. So that's kind of the mindset of participating in markets. Know where to participate. You need to have some edge. People say it's an edge. Edge means advantage against average Joe. Average Joe should know less than you. Not know per se, understand. It's not about insider information. It's about building conviction for future. Like, there is overhype about insider trading. Like, nobody really knows shit except people who work there. And there are laws and regulations to protect them from actually using that information. So throw that idea out of your head that there is insider trading and that you need to be an insider to make money in markets. Like, that's just not true.
Okay.
And so, yeah, you need to build a conviction one way or another by whatever means available to you. And once you have this, I don't know, you wake up one day like, I think I got it. That's when you get in, or at least start thinking about getting in. Yeah, that's in a nutshell trading and markets. And then we have a new asset class, the crypto trading, that appeared on the horizon maybe like 2012, 13.
Okay.
And it became more or less tradable and mainstream by like 2015, 16. And yeah, I mean, that's changed from there. There's a lot of sectors there. There's a lot of technology there. And yeah, you can find a variety of ways to participate in it, similar to stocks, basically. If in stock market, we have stocks and companies, in crypto, we have protocols and companies who develop those protocols. We also have exchanges. We also have miners and oracles and what have you. But generally speaking, if your intention is to become a successful investor or trader, you need to understand why you're going there, what makes the price go up or down, and how to position yourself with these two in mind so that you make money rather than lose money. And majority of people actually lose money, and that's logical, because in order for people to be profitable, they need to take money from other people. If you need to be consistently profitable, that means you need to consistently make money from other people. So either there have to be more money coming into market and new people, or you're gonna run out of people to take money from, So, and that's actually true, right? A lot of people that they traded, they lost money, that's it. Experiment is over. Or they accumulate savings and they come back trying to make it back and so forth. But it's called zero-sum game. For somebody to make money, somebody have to lose money. And
Right.
because of this is a nature, the majority should lose money so that the minority can make times or extra on top of what they put in. Questions?
No, not so far.
Okay. Okay. So I don't have much on top of my head. Where you want to take it next? Anything that you want to discuss?
What would be kind of like an entry level on what kind of like software, or like where can I get like to learn how the process works? I've heard someone about like a soft, like programs that where you can sign up and do kind of like a fake trading first in order to kind of like see how does it work. It's like what would you personally recommend, like how to start with that, like a practical part?
I think, yeah, those things are called paper trading or fake money trading.
Yeah.
And I would not even recommend that. I
Okay.
would recommend to actually trade real money, real assets. Just start small. You can always only bet like $5. You don't really have to go crazy about it. So in order to start, you need to open up account with one of the trading companies. You probably heard Robinhood. You probably heard TD Ameritrade or what others? Interactive brokers and things like that. So whatever you see on TV, all of those you can open accounts by going to websites, and then you can connect your bank account and transfer like, I don't know, $5. And then those companies, they provide you with a trading platform. Sorry. Get back to my thought. So they provide you the software that allows you to have this buy and sell buttons. They also allows you to see the charts that we talked about. And that's it. You open an account, you put some money. You even don't have to put money. You can use that software to look at the markets for free. Like you already have that opportunity. You also can see the layout of buttons and get used to them. You can see transactions flowing, the market transactions flowing. You only need money to usually to initiate a trade. That's that. There are also platforms, I wouldn't say even platforms, services out there like TradingView, where you can see charts and price action without even opening any kind of accounts. So TradingView, trading like trading, view like window, right? TradingView.
Okay, so it's a free app, all right?
Yeah, it's a free app. It's also a website, so you can use it either way. And yeah, that's what majority of people use for watching charts and price. I'm not sure about overseas, but in the United States, that's predominantly what people use to watch price. And you can see anything in there: stock market, crypto market, bonds, mortgage rates, anything. You can start punching in the search line whatever you want to look at, like gold, and it'll show you like gold ETF. And you like, I don't know, oil, it would show you oil futures. And you'd be like, Amazon, it will show you Amazon stock. So, and same goes for crypto. You can type Bitcoin, it will show you the price of Bitcoin. Sorry. So TradingView, I think will be a good start for you. Now, if you actually want to get your hands dirty, then you can open trading account with, I don't know, whatever seems like the easiest. To me, seems like I don't think I want Robinhood because I don't think they provide a online website interface. I think it's better if it's something that provides you desktop or web interface. So maybe interactive brokers or I think it's called TD Ameritrade these days because it used to be Scottrade and they merged with TD Ameritrade. So I think TD Ameritrade is the final name. So
what name? Once again.
TD Ameritrade. TD Ameritrade.
TD
Ameritrade. So they one of the biggest names in there. And Interactive Brokers is the other one. And Robinhood. I think Robinhood added web interface, desktop interface later on, but my experience with Robinhood is only using the app on the phone. I mean, if that's enough for you to get used to and just get a feel, then maybe app on the phone is good enough for you. But I tend to like to have it on a big screen, you know?
Yeah.
And TradingView available on the phone, on tablet, or on the website. Okay, so yeah, that's how you can get started. So to summarize, I don't recommend to do any paper trading. I recommend actually start watching, and if you do decide to get practical experience, just buy like a couple shares or something cheap. So I guess to make it clear, the price of share is for a single share, and you can buy as little as one and as many as much capital you have. The price is per one share. So then you just multiply, right? If you want to buy 10, then whatever, 50 times 10. So that's that. I wouldn't touch futures or options until you get a decent feel for stocks. Now for crypto, if you want to get involved in that, again, TradingView can show you price and charts. If you want to open accounts for trading, I would recommend you to stick with the biggest names in a game, United States-based exchanges, which is Coinbase, Kraken, Bittrex, Gemini. But honestly, Coinbase is enough for you. Just have Coinbase. Kraken is slightly more complex than Coinbase.
Mm-hmm.
And the key everywhere, what we talked about today, is not how to do it, is why would you do it and what's the intention? What makes you think you're going to make money, basically? Unless you feel like you're going to be able to make money, just go have a drink. Just use that $5 to buy a drink rather than, I guess, no, I'll take it back. I'd rather spend money on losing on the stock market than buying a drink because I'm learning how it works rather than potentially impacting my sleep and health.
Definitely, yeah.
Other question?
Well, I heard some of the platforms, they require like an initial capital for the broker to have and kind of like your own account for an opening account. And the one that you mentioned is what TD Ameritrade or Interactive Brokers. Do they require
I don't think they require money to put in right away to open account. I think the only thing they need from you is your name, address, maybe social security, your phone number, things like that. Like same way you open bank account. And
Gotcha.
I don't think they want money from you right away. Like unlike bank account, where you actually need to put money on to open a bank account, trading platforms do not require, as far as I remember.
Mm-hmm.
In fact, they might even give you some bonus. Like if you open an account today, you get like $20 or something like that.
Okay, well.
So yeah, we just understand it's not free money. Understand that you need to have more than average understanding about something to profit. And even that doesn't guarantee that you're going to make money because then you kind of have this pieces together, right? You need to have edge, which is usually knowledge. You need to have trading skills to execute according to your plan and according to what market suggests is going to happen. And you have entry, you have the middle, and you have exit. So you have so many ways to fuck it up. Therefore, I don't recommend to actually even go or venture into trading or investing unless you really have money to spend, or you actually, I don't know, for whatever reason you decide you want to learn this. Because to me, this is very fascinating space, and that's what keeps me going, why I'm keep getting interested in it and staying interested, because it's never the same. It's constantly changing, and you always realize how little do you know, how little you do understand. And I guess that variety, that excitement and curiosity makes it interesting. If I compare it to other fields of life, I don't know, work, sports, what have you, there is always a moment where you kind of either get bored or you get in, usually you get bored because it's either not interesting or you overachieve it, right? You become too good for the game, or it's so difficult that you just stay at the bottom and never really progress. So there is a disbalance between your abilities and what field does give you. With with markets, it's so vast and so changeable, so different every day, then it's like never-ending puzzle. You can always find something that excites you, and even that might change from today to tomorrow. So let's say today you're interested in, I don't know, Amazon. Tomorrow, you think you knew about Amazon enough, and tomorrow you discover that, hey, they have a like hidden fee for some sort of delivery of something that you didn't know yesterday. So that's what exciting about markets. It's constantly changing. And I guess it's also the reason for you to be overwhelmed, because it's constantly changing. So if that's your cup of tea, then you have, it's like a show on TV that never ends, but it excites you, kind of Friends, right? Like you have whatever, 10 seasons and you just keep on enjoying it and you want it to keep on going. But if it's not your cup of tea, if it's getting overwhelming for you, then it's a lot of stress. Especially if you start seeing losses, if you start to trying to make up for your losses, it's become like a Las Vegas, you know? It becomes like it can become end of your life, financially and philosophically speaking. And a lot of people end up that way. So that's why I give a lot of precaution to you and whoever else is interested, maybe watching this video or listening, is that think 50,000 times before you actually decide to make it major part of your life or significant part of your life, financially speaking, because it might consume you as a human, your time, your energy, your motivation, your confidence, your finance. So yeah, it can be nasty if you don't do it right. And it's really hard to make it right. So.
Well, amazing. That's a lot to process. Thank you very much. Yeah.
Yeah. So Max, great for your questions and for your curiosity on this topic. I hope you enjoyed it. And if you have more, let me know. We can do it again.
Sounds good. Absolutely. Yeah. I really enjoyed it.
Man.
Thank you very much. Yeah. Thanks for your time.
Appreciate your time as well. Bye-bye.
Thank you.